Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And today's Saturday. And if you're watching this video on Saturday, I'm going to say you're part of the Cool Kids Club, right? With Velocity Banking Cool Kids Club, because I don't think your average person would watch these videos on a Saturday about learning how to pay debt. But here's the other thing too. If you're in the Cool Kids Club and you're doing velocity banking, you probably have zero in checking and savings like me. So as you can see, every single month when that statement balance comes out on my checking account, it's always a big fat zero, right? Why? Because anytime I have income coming in to my checking account, it leaves the checking account as soon as it hits it. Why? Because it's going to my line of credit, which will be my main operating account. And that's what we're going to do today, right? We're going to do this today. We do this pretty much almost every single day. I've been a little bit busy last week, which is why I haven't been posting. But yeah, let's get to it. So we're going to do velocity banking. And what are the two requirements for velocity banking? Number one is a budget, which we've done, right? Income, expenses, what's left over, all of your expense breakdown. What's the most important thing is that you have all of your debts listed here, because each debt is just eating up into your cash flow, and that's the kind of the name of the game, which is a cash flow, I guess, recovery party, right? And so if you don't have any debt, then velocity banking isn't really going to help you, right? If you make $3,000 of income and you have $3,000 of expenses but absolutely no debt, stop watching this video here. Um, you don't need velocity banking. Okay. So the whole point of velocity banking is to pay off debt quickly using lines of credit as our main operating account, right? So that's the second requirement right here. And let's go ahead and count how much debt this is right here and what our debt payoff is. So this is going to be 30K plus 5 plus 10 plus 15 plus 22. Okay, so that's $82,000 in debt, and then we just have to add the mortgage, and that will be $282,000 of debt. So we're going to pay off $282,000 of debt. Woohoo! And see how we can do that using a line of credit as our main tool. So we're going to just assume two things. Income is the same, and absolutely no savings, because that's what the cool kids do. We don't have any savings in our checking or a savings account, right? And then what we're going to do is use our line of credit as a main operating account. So you might be asking, what's a line of credit? Never heard of that, right? I have a friend who owns a 400,000. I think he bought it for $400,000, a condo in Los Angeles, and then the value had appreciated so much it's now like $700,000. And he asked me, "What's a line of credit?" So don't think just because you own real estate, you even know the basic terms, right? People just happen to buy it because maybe they come from a wealthy family and they just think you could buy any old property and it's cheaper to own than rent because renting is always throwing away money, right? You might hear things like that. And we kind of do a little bit of market analysis in other videos, but back to what I was saying, a line of credit is a tool where you could borrow money, pay it back, and then use it over and over again. So there's different types of lines of credit. There's a credit card, there's a home equity line of credit, there's a personal line of credit. In this example, we're going to use a HELOC, a home equity line of credit, and you might be asking, what's a HELOC? All that is a line of credit, but it's tied to the value of your house, right? It's tied to something called home equity, and you're basically putting your home equity as collateral, right? And when you do that, you get more limits and cheaper rates. That's just the way that the lending world works, right? And so if you put some skin in the game, but you know how to use the tools properly that the banks or whoever is lending it to you gives it to you, then you should be able to pay off your debt in no time, although no guarantees, right? All right. So now what we're going to do is we're going to examine this difference between this column and this column. And the only difference is that we're going to use this line of credit as our main operating account. So let's just put this as a column here. We'll say 10%. We have a $30,000 balance. And we'll just say, maybe we have, I don't know, Let me just kind of take a quick look. We'll just say we have a $50,000 limit, right? Now, I've actually seen statements, financial statements from people who email me like their Excel spreadsheets of someone who has like a $50,000 HELOC and they have a $50,000 balance, right? And when we're doing velocity banking, that should not happen because we're going to use that HELOC as our main operating account. Okay, I'm going to show you the difference when you simply make this as your main operating account. Okay, because the whole concept of the velocity banking strategy is you're going to put your entire paycheck into that line of credit, expenses out, right? That's the basic strategy. And then it's like a cash flow recovery party game, right? They need to make a Mario Party version of this, although they'll never do that. But that'd be cool if they did. Okay, so now what we're going to do is we're going to go ahead and do this. So here's the thing: when you put your entire paycheck into that line of credit, does this HELOC payment really matter anymore? No. In fact, it does two things. It satisfies the minimum monthly payment, and then it minimizes the interest because the interest is calculated by the average daily balance. So I'm going to put this as 0, right? And then so what we're going to do is calculate our cash flow by the top number, your income minus your expenses, and by simply making this as our main operating account, we went from 882 to 1400, right? Simple. It was easy. And that's why, just by this one simple change in behavior, this could, well, 99%, I don't guarantee anything, but almost 99% will probably prevent people from having a $50,000 home equity line of credit with almost $49,000 balance. Okay, because we're going to use our entire cash flow to put this down. And here's the other thing too: we have $15,000 in credit cards. So why don't we just do this? Why don't we just do a simple debt transfer and move this here? So 45,000, and then we're going to do 0, 0, right? And then look how we just went from 882 to 1900 in day one. Like, oh my goodness, mind blown, right? I don't know if you just saw this, but I just went from 882 to 1900 without even doing anything, right? Like, what? Mind blown. So let's go ahead and calculate the next month. So I2 plus 1. And then what we're going to do is take G2. So we're calculating the subsequent balance, and these are the same formulas I use in every single video. So you take the previous month's balance plus the previous month's interest minus the cash flow, and then the cash flow is 1940.71. And then we have to calculate the interest here. I'm just going to assume that the interest is already baked into month 0, just because I don't know what it would be here, but let's just assume that it is in this balance for now. But then for the subsequent balances, let's just go ahead and take the average of these two numbers and then multiply it by the interest rate. And then here's the crazy thing: most people don't understand. So one of the reasons why they get so scared about lines of credit or credit card interest rates is because they actually think that if they have a $40,000 balance, that the monthly interest is going to be 10%. And if I had to pay that, that's like 2 times the mortgage payment, right? But they actually divide it by 12 because it's monthly interest and they're giving you the annual interest rate. Okay, so be aware of that. All right, so now let's see how long it takes us to pay off this debt. And so we can see here a little bit after 2 years. So we're gonna color this here. At 26 months, we paid off $45,000 of debt, right? How easy was that? So now what we do is just say, hey, 45K and then 26 months. And it took, yeah, so we highlight that here and then easy. So now what we got to do is figure out what the loan balances of these two loans are, and including the mortgage, although in general, and this has just been my experience, we always pay the mortgage last, okay? 30-year amortization, that's going to be, so we're going to calculate something called a cash flow index. And what that does is that it sort of ranks, or it's like a ranking system of which loan should you pay off. So would I pay off the $15,000 loan first? Because this is, when I put 30K student loan, that's the original balance and it's the current balance right now. We'll just assume this is a brand new car, brand new mortgage. So what's the one that you focus on first, and then there's two debt payoff criteria. So the lowest balance, high interest rate, highest payment, you look for loans that or debts that fit that criteria, or you could use the cash flow index, which ignores the interest rate. It actually says in if you look up detailed explanation, it says it deliberately ignores the interest rate, right? So you could even have a 0% loan, and if it fits the criteria, you might pay that off first more than a mortgage. Okay. All right, so let's go ahead and calculate that cash flow index. But let's go first, before we do that, let's figure out what the loan balance is after 26 months. So what we're going to go do is go to calculator.net loan amortization. I find this to be the most useful one, even though it's not as pretty as Bankrate. And then just put this $30,000 loan right here. And this is going to be for 10 years. And is it 4% or 4.5? So we're gonna put 4.5, and then we're gonna look for that number, that $15,000 number. So $15,000. So it's right here, and then we're gonna add 26 months. Okay, so 26 months to that would be, so what's 26 plus 66? 26 plus 66. This is embarrassing. I can't do math in my head. So let me pull out my calculator. 26 plus 66, 92 months. So we got to look for month 92. Okay, so this would be 8 grand. So probably, I'm assuming we're going to pay this off first, but I might be wrong. And then the auto loan after 26 months, so let's do this, 22K, 22,000. At 5 years, what's the interest rate here? At 4%. Okay, and then we're going to look at 26 months, what it is here, because we're assuming a fresh new auto loan. All right. And then we'll just leave the mortgage because I just know from experience we pay this off last. But let's calculate that cash flow index, which is the current statement balance. So 8249.51 divided by our monthly payment. So 310.92. Okay. And then this one is 13003.16 divided by 405.16, right? Ignore the dollar sign, probably from the previous formatting. But we always want to, if it's below 50, that means in the explanation, if you look it up online, you definitely want to get rid of it. It's, quote, an inefficient loan. And I always think of this as a ranking system, right? So the lower the number, that's the one you want to pay off first. And so check this out. I move this 8,000. In fact, because these numbers are so low, I'm going to move both of them at the same time, even though it's a 4% interest rate, friends. Okay, so let's go ahead and do this. And how much are these loan balances combined? So let me just combine them for you all. So it goes 8249.51 plus 13003.16. So we're going to move 21 grand into that line of credit. So let's go ahead and do that. And we're going to just go back here and okay. So if we move this 21 grand, right? And you might think I'm insane for doing that. What happens here? Cap 0, 0, right? So our cash flow is now at 2,600. 2,600. Oh my goodness, mind blown. And so let's go ahead and put in our new cash flow number here. So 2656.79. So let's remember that number. And then so after we do that, that's our new number next month, or approximately. So 2656.79. Okay. And then now we just keep copying these numbers and then wait for them to go to 0. Okay. And as you can see here, it didn't take us that long to pay these off. Really simple, easy peasy. Okay. So now at 35 months, we paid off this plus this, right? So this is, I think, $82,000 of debt if I did my calculations correctly. So If so I'm sorry, again, I gotta go back here. So 35 months for $82,000. So we'll put that here. 82,000, 35 months, and here, and then now we got to focus on the mortgage, right? So look at all this extra cash flow that we have. Now here's the thing, if you can decide at this point what you want to do. You know, a lot of people are like, oh, I don't need to pay off my mortgage, it's 3%, I'm going to reinvest it into the market and get more money. I get that, right? But here's the thing, market returns are not guaranteed. Even real estate investment property returns are not guaranteed because you got tenants who don't pay, right? But if you want to just focus on debt payoff, paying off your debt, you know, you can do one of two things. What you can do is, if you're not going to throw this into, well, if you have $2,656, right? It's going to accrue in your savings, and you can directly pay the loan with your savings, right? Or the savings with your loan. And there's doesn't mean you're not going to pay off your debt quickly. You certainly can. I mean, this is 0% interest cash. Why you use a line of credit, right? Makes absolutely no sense. But there's two reasons for that, right? Number one, you throw your cash directly into that mortgage. That money, most people psychologically cannot do that, right? They know that if they put their entire 2,600 into that mortgage, they won't do it, because if they have a flat tire emergency or need extra money right after they put it in there, it's like, oh my goodness, like I can't call the loan company and get that money back. Now, the second thing why they can't, the reason why they can't do it is because, let's say they use a credit card as a backup, right? How do we get to this situation where we have all these payments, right? And again, I have seen people where they send me their spreadsheets and there's like 14 payments and they're making 7,500 a month, like really good income, and they're broke because they engage in something called segregation of income. And so when you add an extra payment and when you don't make it easy for yourself to put your entire paycheck into one place, you're just going to eventually go into more payments, right? More payments. And you engage in that segregation of income. And you can look up the video in this YouTube channel where I explain that. And you have too many payments and your money's spread out all over the place, you're going to go broke, right? It's what happens with a lot of people. But I'm not saying that it can't work. Okay, definitely not saying that. But here's the thing. Let's just use, you know, what we call, you know, I forgot what the way that I heard it was, but the way that I learned it originally was that you just move pieces of the loan to the line of credit around the equivalent of, let's say, your paycheck, so like 5,000, and then you just see it pay off rapidly once you pay it off, once you've maximized your cash flow. This is why I say that you pay off your mortgage last, right? Because that's the one that takes up the least amount of cash flow or compared to the loan amount, and so you want to take, you know, pay off things that increase your cash flow compared to the loan amount or immediately, right? So you saw, like when I put the entire paycheck into the HELOC, oh my goodness, it gave you 515 cash flow. Oh, you paid these off, it gave you immediate cash flow. Paying off the mortgage only gives you a little itty bitty bit of cash flow because just the loan balance is so high compared to the payment amount, right? But luckily, we have this velocity banking calculator to really help us understand how long the debt payoff will be in those situations, right? Where we have a high balance and a low interest rate. Now, we still make the payment, but the payment's going to be from our line of credit. And I'm just going to go ahead and put this in here. So this actually was provided by where I originally learned this from, by Renatus. So here's the thing, if you ever get on a call with me, I'm going to just try to sell you Renatus products because I get a commission, and I think honestly I'm doing you a favor. You ever hear the words, if people don't pay, they don't pay attention? The reason why, you know, there's a lot of people out there who are YouTube geniuses, and again, I'm a YouTuber too, so I like to tell the truth. So um who watch so many YouTube videos and they don't take action is because there's no skin in the game. And skin in the game is the only thing that makes people behave. Now, here's the thing. Is it possible that I charge you like 20, 40 grand and rip you off and do absolutely nothing? Yes. You know, like, again, this is why I don't guarantee anything. This is why I absolutely do not guarantee anything. Because, you know, there was a time period in my life where I took these classes, and then I think for 3 years, I kind of gave up, but at the same time, because I had such a great foundation, when 2021, I bought my first property. 1 year after, I paid off 25% of the mortgage. And I was like, whoa, like, okay, maybe I needed to go through that period where I was just learning. And, of course, I would have loved to have been one of those people who have like amazing results in like 3 months, but I'm a slow learner, or maybe I'm just an average learner. And then we expect so much from our microwave society because that's what we're surrounded by, right? Fast internet, fast food. But I always am in love with like things that are take their time, right? Organic, right? Okay, now back to what I was saying. Um, oh, I'm into. Okay, one other thing I want to mention is that yes, I learned a lot, and I'm actually a part of the Atlanta. I don't even know if you call it chapter, but I was actually leading a study group yesterday for seller finance notes. So we don't just go over velocity banking. Like we're not a one trick pony type of deal, right? Okay, but let me go back to this. All right. So $200,000 loan balance. Now we got to figure out after 35 months what that $200,000, 30 years at a 3% interest rate, and what the balance is after 35 months. Okay. And here's the crazy thing. You borrow $200,000, even at 3% interest rate, that's a 50% return for that. I don't want to say bank because that's not technically true because they just sell off the mortgages once they issue them for the most part in the secondary market. But we'll just say the bank. Make it more dramatic. All right. So $103,000 of interest for that $200,000 loan, even at 3% interest rates. Crazy, right? So let's go ahead and take a look at what that balance is. So is it month 35, I believe? Yeah, 35. And then I'm going to go ahead and copy and paste this figure. The interest rate is 3%. And let's just assume that they got this when it was really cheap. You know what I'm saying? Like my home mortgage is like 2.875. It's insane. But what's even better than a lower interest rate is a low purchase price. If you've ever seen any of my other videos where I talk about this, I do like a one-to-one comparison, like apples to apples comparison between like two balances of loans that have one has a high interest rate and a low purchase price, and then the vice versa situation. And I show like, yeah, even though like you have the same monthly payment, if you learn to do velocity banking and pay off this mortgage quickly, you win when you have the low purchase price and high interest rate. And I need to make a video about like the psychology of why a lot of people prefer that high interest rate. I mean, high purchase price and low interest rate, right? So let's go ahead and put this here, 30 years, and the payment amount is 843.21. So 843.21, and then we'll just say that the amount that we move from the loan to the line of credit will just be in $5,000 chunks. And then what we do is we put our entire paycheck into that line of credit. And what is our expenses right now? It's going to be, let's see, 1,500. Everything except for the loan we're trying to pay off. Whoopsie, not here. So 1,500. And then as you can see here, it'll take 4.9 years. All right, so 4.9 years, good deal. So, whoopsie, my screen just turned black. Yeah. So now 4.9 years, how much is that in months? Or I could just do this, 4.9 plus 35 divided by 12, 7.81 years. So 282K, 7.8 years. And we're debt free. You ever see those videos where like people say I paid $10,000 of debt in like 1 year, and I'm like, every time I do this, I'm so surprised because like those videos have 100,000 plus views, and mine just only get like 100, 200 views. Although I do have some kind of semi-viral videos, but to me, like when someone says like, "Oh, I paid off $10,000 of credit card debt in like 10 months," I'm like, "That's it." You know what I mean? But that's because I paid off $58,000 of mortgage in a year. Okay, well, this is Korean Atlanta Mentorship. So if you're interested in being part of that Velocity Banking Cool Kids group, and not only do we study velocity banking, we study all these other things too that I talked about, like seller finance notes, go ahead and click the Google form link below. Other than that, have a great day, everybody. Happy Saturday, and I might crank out another video before I go to sleep today. Bye bye, everybody.